Hi, I'm Taryn Rolton, board member at the International Federation of Accountants. People often ask me about financial statements and what they mean. Accounting is a language we use to measure and report business results. That means you don't need to be an expert in math to be able to read a set of financial statements. In this video, I want to give you some information about what financial statements are and how they are used. Let's start with an example. Let's say you find a company that's making an exciting new product. How do you know about the financial health of the company and whether you should buy their stock? Many companies report how they are performing through financial statements. These can often be found online, where members of the public like us can buy the company's stocks. So what are financial statements? Financial statements are reports that include an income statement, a balance sheet, and a statement of cash flows. A financial statement can tell you all sorts of information. How much a company makes, how much it spends, how it manages its money, and how well it does all those things. They use agreed rules, we call accounting frameworks, so the information is consistent and comparable between companies. Let's look at the income statement. The income statement looks at a period of time. It tells you how much money the company earned and how much is spent during that time. And the difference between those two things is its profit or loss for that period. Like the income statement, the cash flow is also measured over a period of time. Cash is the lifeblood of any business, and the ability to generate cash from what you do is vital. The cash flow statement tells you about how cash goes in and out, and whether the company has money to cover their obligations to employees, suppliers, and others. It's a similar concept to your bank statements that show what comes in and out and how much you have left. Balance sheets tell you about what the company owns, its assets, what it owes to others, its liabilities, and what is held in shareholders' equity. Unlike the income statement, which covers activities over a period of time, the balance sheet is a snapshot of a company's worth at a point in time. Financial statements also include a statement of shareholders' equity. This is the difference between the excess of the assets the company holds and the amount it owes in liabilities or book value. It is important to understand that book value and stock market value are not the same thing. Shareholders' equity represents funds already invested in the business and accumulated profits and losses from previous years. These profits could be reinvested into the business or returned to the shareholders. Footnotes in financial statements give you additional details. For example, the footnotes will tell you about related parties, so you know if the company's only buyer is the owner's brother, or whether there are just one or two customers, which could be risky. Remember I said that accounting is a language. Financial statements tell us how the business is doing in terms of money. Your understanding of the company's activities is really important in interpreting financial statements. Does the story these numbers are telling match what you know about the company from other sources? Management's discussion and analysis, or MD&A, can provide valuable information about this in addition to what you read and see elsewhere. Going forward, financial statements may tell more than just financial returns. We're going to see important information such as climate disclosures and how environmentally friendly a company is coming into reports to help us understand the bigger picture of what a company does. So where can you get a copy of a company's financial statements? If a company is public, a regulator will require that financial statements be available to the public. For example, on a regulator's website or published on the company's website.